Have you ever imagined stumbling upon a treasure map that led you to a gold mine? But the catch was that the clues were right under your nose the whole time. Discovering a treasure map might seem like a fantasy, but in the real estate world, it's a reality waiting for those with the right insights. The market is a labyrinth, and its corridors are packed with secrets, each one a stepping stone to unimaginable wealth. Surprisingly, many of these secrets are hidden in plain sight, masked by misconceptions or simply overlooked. The elite guard these secrets closely, using them to soar high above the average investor. It's not just about buying property. It's about strategic acquisitions, understanding market cycles, leveraging assets, and making the tax system work for you. These aren't mere transactions. They're moves in a grand chess game. With the right knowledge, anyone can join the ranks of the top real estate moguls. The question is, are you ready to unlock the treasure that's been right under your nose? Get ready, because we're going to share the secret tips used by the best real estate experts. 1. The hidden power of leveraging. Leveraging in real estate is like using a magnifying glass to focus the sun's rays. It amplifies your purchasing power. Picture this: rather than buying a property by paying the full price, top investors often use a small portion of their own money and borrow the rest. This strategy is called leveraging. For instance, if they want to buy a property worth $100,000, they might only use $20,000 of their own money, a 20% down payment, and borrow the remaining $80,000. By doing so, they control the entire property, worth 100% of its value with just 20% of the cost. This means they can buy more properties with the same amount of cash on hand. And as these properties grow in value or earn rental income, the returns aren't just on the $20,000 they invested, but on the property's full value. It's a powerful way to maximize potential profits. 2. Neighborhood revitalization. Neighborhood revitalization is akin to spotting the potential in a rough diamond. While many focus on already polished gems or established neighborhoods, astute investors often search for areas showing early signs of growth or transformation. Such neighborhoods are typically earmarked for new infrastructure developments, like roads or public transport. They might also see an influx of artists or entrepreneurs, hinting at a budding cultural scene or upcoming business hubs. For example, consider the transformation of New York's meatpacking district. Once an industrial zone, it began attracting artists and creative businesses in the 1990s. Early investors recognized this shift, acquiring properties at relatively low costs. Today, it's a vibrant area boasting high-end boutiques, renowned restaurants, and the famous High Line Park. Those who invested early reaped the benefits of a dramatically increased property value. Hence, the key is to observe, anticipate, and act before an area hits its peak, maximizing potential returns. 3. Tax benefits and write-offs. Tax benefits and write-offs, though not the flashiest aspects of real estate, are the silent workhorses propelling successful investors ahead. Think of them as backstage passes that allow one to reap extra advantages. For instance, if an investor borrows money to buy a property, the interest they pay on that mortgage can often be deducted from their taxable income, reducing their tax liability. Moreover, properties naturally wear and tear over time. The tax system recognizes this through depreciation. Investors can deduct a portion of the property's value each year, which effectively decreases their taxable income. Let's say you own a rental property valued at $200,000, excluding land, with a depreciation life of 27.5 years. Each year, you could potentially deduct around $7,273 from your income. Then there's the 1031 exchange, a jewel in the tax code. If an investor sells a property and reinvests the proceeds into another, they can defer paying capital gains taxes, allowing their wealth to grow faster. This is financial alchemy, transforming potential tax payments into further investments. 4. BRR strategy. Buy, rehab, rent, refinance, repeat. This model has made many millionaires. It involves purchasing a property below market value, renovating it to add value, renting it out to generate cash flow, then refinancing based on the new, higher value. This method can help you pull out most, or even all, of your initial investment to invest in another property, creating a compounding effect. Let's dive into a concrete example to illustrate its efficacy. Imagine a neglected house in a decent neighborhood, listed for $80,000, while comparable, well-maintained homes are valued at $120,000. An investor spots the opportunity, buys, and spends another $20,000 fixing it up. Rehab. Now, the house isn't just aesthetically pleasing, but matches the standards of the $120,000 homes nearby. Next, the investor rents it out, securing a steady monthly income, rent. After some months, with a spruced-up home and rental income as evidence of its profitability, the investor approaches a bank and refinances the property for its new value of $120,000. The bank may agree to lend up to 80% of this, giving the investor $96,000. After repaying the original investment, they are left with capital to repeat the process, possibly without injecting any more of their own money, thus setting a cycle of continuous growth. 5. Off-market deals. Off-market deals, commonly termed as pocket listings, are like the hidden gems of the real estate world. These properties aren't publicized on mainstream platforms, making them elusive to the general buyer. For savvy investors, such exclusivity can be gold. How? It minimizes competition, granting them leverage to negotiate better prices and terms. For instance, consider Sarah an investor. Through her close network, she learns about a homeowner wanting to sell quickly due to a job relocation. This property isn't listed online to ensure privacy and a swift sale. Sarah approaches the homeowner directly, bypassing bidding wars or traditional market delays. As the sole potential buyer, she negotiates a price below the estimated market value, saving her tens of thousands. Such insider knowledge can be harnessed by cultivating relationships with industry professionals, like real estate agents, attorneys, or even property managers. These connections become invaluable eyes and ears, granting access to prime properties before they hit the broader market. 6. The 50% rule in rental properties. The 50% rule is an ingeniously straightforward guideline that serves as a preliminary litmus test for rental properties. If you're looking into a potential rental property, anticipate that approximately half of the rental income will be absorbed by various expenses. Except the mortgage. Consider an investor, Alex. He's eyeing a property that can fetch $2,000 in monthly rent. Applying the 50% rule, Alex anticipates $1,000 of that to cover costs like maintenance, property management, taxes, insurance, and potential vacancies. The remaining $1,000 can be directed towards the mortgage or become profit if the property is mortgage-free. This rule doesn't replace detailed expense tracking or thorough financial analysis. Instead, it offers a quick snapshot. If a property passes this initial screening, it signifies potential profitability, prompting a deeper dive into precise costs and revenue projections. For seasoned investors, this rule is a time saver, sifting out less lucrative opportunities at first glance. In the end, the path to becoming a successful real estate investor isn't shrouded in impenetrable mystery. It's paved with knowledge, strategy, and adaptability. By leveraging these secret tactics, you're not just buying property, you're strategically building a portfolio that can weather storms and capitalize on opportunities. Remember, in the world of real estate, knowledge truly is the most valuable currency.